This strategy will change your trading. It is a timeless technique used by some of the most successful pros in the industry to make full-time income. This strategy is not based on any fleeting market fads. It's a proven method that will continue to generate profits no matter what the market does. In this video, I'm going to reveal to you all the details of this proven strategy, and I will show you how to use it to make real money in the stock market. One of the things that sets this day trading strategy apart from others is it's not based on any lagging indicators or made up patterns. You won't find any RSI usage or fib lines here. Instead, this strategy is based on the market itself. That's right, the market is the indicator. This allows you to take advantage of opportunities as they arise instead of being stuck waiting for lagging indicators. So how does this strategy work exactly? It's actually quite simple. This trading strategy involves searching the market and constantly monitoring to find and identify stocks that are either outperforming the market or underperforming relative to the market, as represented by a benchmark such as by the S&P 500. This technique is called relative strength and relative weakness. When a stock is demonstrating relative strength by outperforming the market, it may be a good time to buy and hold the stock. And on the other hand, if the stock is showing relative weakness, it might be a good time to short or buy some puts on the stock, which is a way to profit from the stock's declining price. By focusing on stocks that are either outperforming or underperforming relative to the market, a trader can potentially take advantage of the market fluctuations and generate consistent profit. Additionally, by selecting stocks that are rising more proportionally than the overall market, even if you can get the market direction correctly, you will make much more money proportional to the market, and you will achieve higher returns than simply buying an ETF or trading features such as ES and MES. Although keep in mind, it is not that simple to just buy when the stock is strong or sell when the stock is weak. You need to be able to fully understand how to implement this strategy into your trading instead of just basing your trades on relative strength and weakness alone. One of the keys to getting the most out of this trading strategy is to only take the highest probability setups, which can get you upwards of 75% to 90% win rate, as some of the best traders do. First and foremost, it's important to trade in the direction of the market. If the market is going down, do not go long. If the market is going up, do not go short. This might seem like common sense, but it's amazing how many traders counter trend and try and catch a falling knife and end up losing money as a result. Another high probability setup is a stock that's breaking out of compression or a major moving average on the daily chart, such as the 50 moving average, the 100, and the 200. These levels are often watched by institutions and can be key areas of support or resistance. Additionally, you only want to take trades that have relative strength or weakness to the overall market or SPY. This helps ensure that you're taking trends that are in line with the overall market trend, and you can make proportionally more money than buying futures or ETFs. One of the key factors that can increase the probability of success of a trade is entering trades with high relative volume in the stock. This can help validate a move in a stock. For example, if a stock is breaking through a major moving average on high relative volume, this can be a strong indication that the move is being driven by institutional activity. High relative volume can confirm if the move is not just a short-term blip drifting over a major support line, but rather a sustained trend that is likely to continue. By combining high relative volume with other high probability setups such as breaking out of compression or a major SMA, you can increase your confidence in the trade and make informed decisions with greater certainty. One of the benefits of this trading strategy is that it allows you to take advantage of stocks that are relatively strong or weak against the market. Like mentioned before, it tends to move exponentially more than the market, giving you the opportunity for greater profits. For example, if the S&P 500 moves up $1, a relatively strong stock might move up $2 per share, giving you much more profit. Similarly, when a stock is relatively weak, it may go down exponentially compared to the market, and this can be a great opportunity to profit from market downturns. Another advantage of this strategy is it allows you to survive pullbacks in the opposite direction. When the market is in a bullish or bearish cycle in the 5-minute chart, a stock with relative strength or weakness will often go into compression and go flat, rather than moving in the opposite direction against you. This can give you opportunity to hold on to your trade as long as your thesis is correct, and you can ride out the storm while waiting for the market trend to reverse back into your favor. Finally, you want to look for a great daily chart for longs or a bad daily chart for shorts. The daily chart needs to align with the 5-minute chart to increase the probability of your trade. This is important because it allows you to hold on to your trade even if it doesn't go your way right away, and you're able to stay into the trade as long as your reasons for entering are still correct. Of course, it's important to remember that even the highest probability setups can sometimes go against you. That's why it's crucial to manage your risk carefully and never force a trade. If the market is in a tough condition and you can't find any high probability setups, it's better to sit on the sidelines and wait for better opportunities to come along. Your job as a trader is not just to trade, it's to make money. So always be patient and wait for the best setups to present themselves. The reason this day trading strategy is here to stay is because it capitalizes on institutional involvement in stocks. Instead of trying to predict tops or bottoms or chase fleeting market trends, we're here to simply follow the big money. Institutions may try to master movement in and out of stocks, but it's impossible for them to hide their billions of dollars. By following their breadcrumbs, we can make informed decisions on where the market is potentially heading and take advantage of their involvement in stocks. This means that as long as institutions are trading in the market, the strategy will remain relevant. It's a timeless technique that is not based on any fleeting market trends or fads, but rather on the big guys driving the market. So even if the market changes or evolves over time, the strategy will continue to generate profits as long as the institutions are active. Thank you guys for watching this video on one of the most powerful trading edges that you've probably never heard of. I hope you found this information useful and are excited to start using this in your trading. If you have any questions or would like to learn more, feel free to comment down below. Make sure to subscribe to stay up to date on one of the best strategies. Thank you for watching, and I'll see you guys in the next video.